whenever you look at Bitcoin's chart, all-time chart in linear terms, it's either a massive bubble or it's a massive burst. And there's really never anything in between. And if you look at like a logarithmic chart, you can really get a clear story of like what's actually happening. It's that, this thing's going through massive boom and busts on its way to becoming somewhat of a global reserve asset, or something maybe much bigger.
Welcome to the second Swan Salon in Miami. I'm Nico Moran. I'm the host of Simply Bitcoin. I'm also part of Swan Media as well. Swan Salon is an exclusive event for Swan private members. And it's a great opportunity to network with some of the brightest minds in the industry. We throw these events not only in Miami, but in Los Angeles as well. Thank you all for coming. Really appreciate it. Today's fireside chat is going to be with Dylan LeClair. Dylan LeClair is the senior analyst at UTXO Management and head of market research at Bitcoin Magazine. And our own Ryan Flynn, managing director of Swan Advisor Services. Please give these gentlemen a round of applause. Ryan, it's all yours, my friend.
Thank you, sir. Thanks for putting this all together. It's a great event. Thank you all for coming out. It's nice to see some familiar faces in the crowd and meet some new ones. And we're going to talk some macro today with Dylan here. So I'm certainly no expert, but I work with our private clients at Swan and our financial advisor partners, and we field a lot of these types of questions from our clients. So it's great to have Dylan here to help us sort all this out. So thanks, man, for coming.
Of course, happy to be here.
Yeah. So I thought we'd start maybe kind of super high level, 30,000 foot view kind of deal, then kind of work our way down a little bit with a more narrow focus, and then maybe kind of end up on what's going on more recently with Bitcoin price action and kind of catalysts around that. But sort of the broad macro picture, sovereign debt situation. Can you give us kind of an overview of where we are with that right now? Kind of debt to GDP levels and liquidity levels and interest expense kind of ratios moving up. Where does that sit in your mind right now? How does that picture look, and how's that trend looking?
Yeah, you cut out a little at the end there, but yeah, I think when you're talking about Bitcoin, like the broad Bitcoin thesis, and you can kind of separate it in a bunch of different buckets. Like I know you can approach Bitcoin as like the cypherpunk, kind of thesis, or there's like obviously the energy industry, which is really fascinating. But when you're talking with like the macro investor crowd, when you're kind of explaining why Bitcoin an investable asset, as an investable asset is important, I like to really like zoom out, 50 years plus and really like kind of contextualize the situation a bit, right? So we are 50 plus years into this fiat currency experiment. We're coming off the backs of 40 years of lower lows in interest rates. At the same time, we saw the greatest secular asset boom of all time as a result of that cost of capital going from 20% to about zero. 2021, you can broadly characterize it as a global everything bubble. When the cost of capital is zero, in real terms, when the price of money is negative, in theory, the theoretical value of every asset on the planet is infinity. Obviously, that doesn't work. That doesn't, that mathematical formula doesn't compute, and things get really, really weird. And you have, pictures of JPEG rocks selling for millions of dollars, and you have, SPACs that, produce no revenue, no profit, going for billions of dollars. Things get really, really funky, right? So, sovereign debt is an asset class, right? You had, $20 trillion of negative nominal yielding debt. So what does that mean in layman terms? There's $20 trillion of capital out there that was invested, $100, to receive 99 back in 20 years. And who in the right mind would do that deal? And the reality is, well, that's where we were. Whether it was investment mandates or just pension managers that it wasn't their own money, they didn't care. You had that just cost of capital was so bloated, so out of whack, that things got really, really funky. So post 2021. That started to unwind, and it started to unwind in a pretty dramatic fashion. We saw the greatest bond market sell-off in 100 years. With that cost of capital rising, we saw stocks sell off. Bitcoin, crypto sell-off, everything sold off, and kind of a lot of the convenient narratives for Bitcoin kind of were not proven wrong, but at least temporarily looked to Bitcoin's an uncorrelated asset. Well, it was correlated with risk for all of 2022. Bitcoin has an inflation hedge. Well, inflation was at 40-year highs and Bitcoin was down 60%. What went wrong? And I think it's really like this is why it's important to zoom out and contextualize it. Bitcoin is not a CPI inflation hedge. If CPI ticks up 1%, consumer price index, and Bitcoin sells off, well, what went wrong? And I think it's important to realize that Bitcoin is what Bitcoin is at its core to me, and to I think a lot of people increasingly, it's an engineering solution outside of this system, right? So we're 50 years into this fiat currency experiment where money and capital is backed only by debt itself. We're no longer on a gold-backed standard. That was abandoned in 1971. The U.S. defaulted. We've defaulted twice on the debt. First time in 1933 when FDR confiscated our gold, revalued it higher, and we kind of were on a quasi-gold-backed standard post-Bretton Woods, 1944. And then they defaulted again in 1971 when they basically said, no, France, no, all these countries, we're not valuing your dollars against gold anymore. It's just debt now. So we're 50 years into this experiment. It's relatively new. Like people think Bitcoin is pretty new, 13, 14 years old. Well, global fiat money as we know it is really only 52 years old, right? So 25 Bitcoin is like 25% of the way there. It's just barely turned a teenager. But it's really, compared to fiat, global fiat currencies, like it's not actually that young because fiat is still kind of early in this experiment. So, long story short, right? Yeah. Debt levels across the world are so bloated, right? I think every investor on the planet has to ask themselves, how does this resolve, right? Because the history of debt, economics, currencies show that when you reach these debt levels, defaults occur. And defaults can occur in two ways. They can occur explicitly or implicitly, right? Either a default as in, I loan you money, you don't pay me back. Or, I loan you money and you pay me back, but what you pay me back in is fundamentally worthless or worth a lot less, right? And so I think that's the $100 trillion question. And I think that's for me, the bull case for Bitcoin is that $100 trillion question for 99% of investors goes unanswered.
Yeah. I mean, so how long do you think that this fiat experiment can continue? I mean, the Fed, the Treasury are pretty good at keeping this going. Do you see us getting to a world 10, 20 years out where we are at 200%, debt to GDP or, $3 trillion in interest expense? Like, how long do you think this goes? And obviously things get weird along the way, but how long can they keep that sort of ball in the air, do you think?
Yeah. So I mean, I think it's interesting. Like post Great Financial Crisis, there was a bunch of like academic papers from the IMF and the World Bank and the Fed, where they basically were saying like, hey, like the debt loads are so out of proportion. They're so far gone. The only way out is financial repression. In layman's terms, that means a period of time where inflation is far above interest rates. If you actually look at like what the Fed and all of these guys at the Treasury were saying post COVID. They were saying, well, we need inflation high. We need inflation. We need to let it run hot. We need to let it run hot. And like, why were they saying that? Like, why do they want this arbitrary inflation number to be higher than 2%? Like, why were they actually saying that that's what they wanted and that's what they got? Well, it's because debt levels needed to be eroded in real terms, right? So they need that debt burden down in real terms. And how do they do that? Well, they let inflation run. They keep interest rates low. I think what they didn't see, they didn't perceive is that the social pressure and the political pressure of that inflation going from 2%, over the last 2 decades, really, on an annualized basis to, 6, 7, 8%, 9%. That's when the political pressure really kind of, you saw a lot of both Democrats and Republicans in the U.S. and globally, right? Direct pressure at the Fed, at central bank institutions. And so now, we just went through the fastest tightening cycle in history, and I think we're in at least for the next probably 12 months, we're at a period where those interest rates are going to remain very, very high. So how long can they keep this game going? I think, unfortunately, like longer than a lot of Bitcoin proponents would like to believe. But that doesn't mean that, I think it's inevitable that they will continue to print money in simple terms. Probably more, they'll come out in whether it's 12, 18, 24 months with some word salad facility where they're basically just buying debt, monetizing debt. Because mathematically, there's not enough buyers of debt. at the sovereign level. And
so you don't see QE as sort of classically defined. They're going to find other ways to get liquidity into the market.
Yeah, and the U.S. we should like contextualize. The U.S. is like the cleanest of the dirty shirts, as some like to say. I think maybe that's a false term. Yeah. You know, the European Union, the Bank of Japan, China. I mean, they are in far worse positions, both demographics wise and debt burden wise. So the U.S. like the dollar isn't going to go away. It's not going to die tomorrow. It's not going to die in the next 10 years. But that doesn't mean that some form of alternative store of value. Or currency system altogether, right? We're just talking about the Western world here generally. If you like, we can get into the medium of exchange talk with Africa and a lot of the developing nations where Bitcoin isn't just a speculative financial asset like we think of it or talk about it, right? It's actually a currency that's being used. It's actually a unit of account even. Yeah. But that's a different story. I think the real Bitcoin story is going to be probably characterized by Western capital flooding in. And right now, fortunately or unfortunately, depending on how you look at it, 99.9% of people don't understand it and don't understand what game is actually being played here. It's just, another risk asset that's correlated with a basket of tech.
Yeah. I think that's a great point. I mean, the information asymmetry is huge, and that's really the investment opportunity that we discuss with our clients, in terms of closing that knowledge gap. So in terms of, sort of zooming in, maybe shorter time frame, next 12, 18 months, like maybe paint the picture of what the general consensus was heading into the end of the year last year, going into 23, around expectations for inflation and interest rate, Fed future, sort of predictions there. What did that look like coming into this year? And now as we sit in sort of nearing end of Q1, what was wrong about that view, and sort of what has changed in your mind sort of going over the next 12, 18 months?
Yeah, I think one of the things that a lot of people got wrong, including myself, in terms of the timeline, was that as it was clear that they were going to really tighten the belt, we had this inflation at 40, 50-year highs, fastest tightening cycle in history, biggest wealth destruction in absolute terms in history, tens of trillions of dollars of wealth destruction across stocks and bonds. Kind of thought that this global slowdown might have happened a little sooner, and I think that was a little bit naive if you just look at the history of these boom and bust cycles. The Fed calls it the wealth effect, right? But there's a feedback loop there in terms of both on the upside and the downside. When you see these massive asset bubbles boom and bust, there's a feedback into the real economy, and I think that's going to take some time. So what the market's broad expectations were, honestly, for a period of time, what my expectations were was that the bust phase of this kind of economic cycle was going to happen a little bit sooner. What we see now is that inflation is very, very entrenched. The economy is actually still very hot in nominal terms. So in real terms, there's not really much growth. In nominal terms, whether you want to look at GDP or just, like whether it's wages, it's still pretty piping hot in nominal terms. So the market generally thought, okay, we're going to, really tighten fast in 22. There's going to be kind of a bust recession in 23, and then the Fed's going to cut. And what's looking increasingly likely is that there's not actually the bust happening this year, and inflation is still a lot hotter than people thought. We're not going to magically return to this 2% level like all the Fed economists wanted and like a lot of Wall Street analysts expected. And in the reality, kind of whether it's a psychological thing or just a lag effect, this inflation is very, very entrenched. And because of that, we're going to see a sustained period of higher for longer in terms of interest rates. And so that monetary policy does have a lag effect, and I think that's when 2024 is what I think a lot of people thought 23 was going to be, in the sense of the real economy starting to feel this pretty massive tightening effect.
So do you think that is there a realization that maybe monetary policy is divorced from inflation in some ways, or is it just there still is a relationship there, but it lags more than people expect?
There's definitely a relationship. That tighter the higher that interest rates go, that in theory and in practice, I think with a lag, the lower that inflation will be. I mean, they're telling you, right? The Fed's saying, okay, we're going to raise rates to destroy demand. We want unemployment to rise. So they're basically telling you, we want you guys fired. So you spend less, so inflation goes down. I mean, that's the economic system we're in. It is, however backwards it may be, that's the world we're in, right? So, and they're doing this because of some arbitrary mandates that they have at the Fed. It's maximize employment and inflation, right? And so that 2% target is what they're looking for, and they're willing to sacrifice some jobs to do it. So I think that's what we're in for. They actually want pain. They're saying that if you just listen to the press conferences. I mean, it's kind of weird that this tea leaf Fed, this kind of Fed speak is even part of the investable landscape. But that's the world we're in, right? Yeah. They said, hey guys, like COVID came around. They said, we're going to print a bunch of money, like buy anything and everything is going to go up. They didn't say that explicitly, but that's what they said. In November of 21, they came out. They're like, hey guys, like, they didn't say the party's up, but they said, for a little bit, the party's up. We're going to tighten the belt. And I think when you just look at the history of tightening cycles and the history of wealth destructions that we've seen with stocks, bonds, real estate, I think that's impending. There's more of a lag there. You do see this feedback loop. You do see these downturns, and ultimately, the pivot that everybody's looking for in terms of monetary policy happens only after things get pretty ugly.
But wait, what would you say about the recent unemployment rate numbers?
So near 50-year lows in terms of unemployment. There's a lot of structural reasons there. Part of it's demographics, right? The largest the largest generation ever, the baby boomers, are retiring. So there's like structural labor shortages, or like a structural labor shortage, or just kind of a misalignment, especially post-COVID, with kind of this white collar. We're kind of in a white collar recession, right? You see all the tech companies are laying off, but the service industry is piping hot, right? So there's a lot of kind of misalignment there, and I think that's one of the reasons that the Fed is saying, okay, we're gonna stay on the pedal and really kind of tighten the belt here, and we want pain. And so because of that low unemployment rate, they have they have a lot of reason and ability to continue to tighten. They want to see that slack, and that's what they're saying.
So kind of view over the rest of the 23 is higher for longer in terms of interest rates, structural impact on inflation, sort of zooming now into Bitcoin price action over the first part of this year. It's been kind of interesting to see how that's played out given, the broader landscape. I think Bloomberg published an article yesterday around, Bitcoin's lowest correlation to equities in 2 years. What do you think is sort of the, can you speak to any sort of catalyst that's popped in your head around this recent movement in Bitcoin's price as it relates to the broader macro environment?
Yeah, we saw quite a rebound in quite literally like almost every asset class to start the year. Bitcoin performed fantastic, up 50%, risk adjusted. I think was the best performer. Goldman Sachs published a report of best performing asset classes to start the year in risk adjusted terms. And Bitcoin was at the top of the list, so that was certainly interesting to see. But I think if you just look at Nasdaq, S&P 500, long bonds, it was all kind of the same trade. And I think that's kind of the story. That was a story in 22. That's a story now. And so don't get me wrong. We saw the biggest capitulation event in absolute terms of Bitcoin's history. And at a certain point, just a lack of sellers in any market, never mind Bitcoin. And the price goes up, right? And so Bitcoin's very inelastic, right? Absolutely scarce. Price is set at the margin for any asset, but especially one that trades on pretty thin volume, and that's a good thing in a bull market, and it's a bad thing in a bear market. Probably one of the things that I got wrong in terms of the past 24 months or so, 18 months or so in Bitcoin was that I was looking at all this data, and it was like, hey, 80% of the supply is just price agnostic. It doesn't care. They're just not selling, and I was like, okay, well, in that case, I think Bitcoin can really decouple regardless of what the macro looks like, and that was a thought I had in late 21 when we saw that second leg of the double bubble and Bitcoin made a new all-time high, and as it turns out, right, like that supply inelasticity of Bitcoin, while it is a massive catalyst for bull markets, you don't really need all that much selling to drive the price down, right? Like if you have a cohort of people, right, like the stackers, the hodlers of last resort that say, okay, we're going to buy at any price, we're never selling. Well, that's great, right? But all it takes is a little bit of selling, right? And the market can really kind of fall off. Never mind that we also had a bunch of leveraged players and implosions in the altcoin space. We could go there if we want, but in terms of at the start of this year, I think that correlation with equities is going to remain, fortunately or not. I actually think it's a good thing. And I think Bitcoin's path to a $10, $50 trillion and those are big numbers, right? Bitcoin's a $400 billion market cap, so a 10 trillion, right, is an order of magnitude, a 20x from here, 25x. But I think that correlation, if we want Bitcoin to be this global reserve asset, which I believe it will be in my lifetime, in all of our lifetimes, then it's going to be correlated with the kind of the liquidity tide, if you want to say it like that.
Yeah, I think that's right. Maybe this is a sort of a quick aside, but I know you spend a lot of time with on-chain data and analytics. Is there anything there that you'd like to speak to around stuff that you saw emerging out of that data set that was good indicators for you as far as how this was going to play out over the last 6 months? I know sometimes it gets a bad rap in terms of spending too much time and focus on-chain data, but maybe what did you see kind of out of that data set that maybe even looking backwards was like, oh, that was a great indicator there?
Yeah, I think it's interesting that, as different as this cycle was compared to the previous ones. I mean, it was obviously an order of magnitude larger, with a bunch of different catalysts, a different narrative, different players, different blow-ups, different media cycle. It was very much similar in terms of, the kind of the boom bust we saw. Like every single Bitcoin bull market, basically see the exchange rate goes like 2, 3, 4x above the average price that a hodler paid. So we can transparently see the ownership of all Bitcoin on the network. All 19 million Bitcoin, we can see when's the last time they moved. So with that, we can kind of there's moving averages in traditional markets. Well, with Bitcoin, we can basically take a precise average of the price of every Bitcoin the last time it moved. And in a bull market, traditionally, we see the average price of each Bitcoin was let's say $20,000. So the Bitcoin hit an all-time high of 69,000, right? So about 3x higher than that average price. And every bear market, conversely, we see that the exchange rate falls below that average price. So on average, all the hodlers, on average, are underwater. And we see that every single bear market, and we saw it again, right? So that average purchased Bitcoin price was 22,000. Bitcoin went to 15K. That average price actually dipped below 20,000. So we saw some losses realized. But I think that's just probably one of the kind of indicators that I look at in terms of obviously the macro correlations matter. If you think of just simple math here, BTC/USD, the USD strength, Bitcoin being a global asset trading in every jurisdiction on the planet, that USD strength is going to continue to matter, USD strength or weakness. But in terms of the Bitcoin numerator of the exchange rate, we saw a capitulation. There's no doubt about that. So could we go lower? Could we retest that 15, 16,000? Sure. Probabilistically, I would always say there's a chance.
Yeah.
But we absolutely saw capitulation in every single piece of data that you can look at. Bitcoin native of affirms that same thought.
Yeah, and I want to maybe pivot a little bit here to get into the fixed income side of things. I know you spend a lot of time writing and talking about fixed income. Obviously, that's the sort of 800-pound gorilla in the capital markets. We saw that sort of strange behavior last year where it moved in line with equities, so it sort of decoupled their relationship historically and became less of a actually a terrible diversifier in sort of a traditional 60-40 portfolio. What do you think? What's the catalyst to get more of that capital flowing out of fixed income and into Bitcoin? Is there a simple way to kind of think about that? Is it tied to the interest rate cycle? Are those higher for longer expectations keeping more capital in fixed income right now?
Yeah, I think I always return back to the premise of, okay, so debt levels are here, 120% debt to GDP on a federal level. Total debt to GDP is 400, 350%. And if you just look at the history of financial markets, those can't be sustained. So mathematically, they have to lower that. They tell you that they're going to lower it, and how are they going to do that? Well, financial repression, right? So sustained period of inflation above interest rates. We've already seen a year or two of it, right? Where fixed income drew down because interest rates went higher, so that anything long duration, 10 years, 20 years, 30 years, drew down. But if you hold that to maturity, you don't realize the loss. But the loss is realized in real terms, right? The loss is realized because you own a bond that's yielding 2% and inflation's 8%, so your purchasing power goes down, right? I think the bull case and how I think about fixed income as an asset class other than just like a trade, right? Where like if you buy a bond, a 30-year bond, and rates are 4% and they go to 3%, you can realize a capital gain. But I'm talking about like holding fixed income to maturity as an asset class. I don't really see a bull case, like because we're due for a period of inflation much higher than those rates to get out of this debt level. So I'm not. I don't. I mean, I hold short duration, like six-month treasuries give you 5% yield, right? That's basically cash. That's cash-like. But in terms of like the bull case for bonds, I don't really see it on a long time frame. And I think ultimately the world is going to wake up and realize that in an inflationary regime, if you look back to the 70s, if you look to just 2022, how that acted, the stock bond anti-correlation, right? Like the world's biggest hedge fund manager, Ray Dalio, made his career on being long stocks and long bonds because and being levered long bonds, because when stocks drew down, bonds would go up, meaning like they'd cut interest rates, so the value of bonds would go up because bonds and the yield have an inverse relationship. So that regime of stocks and bonds being inversely correlated wiped everybody out last year when they were 1-to-1 correlated for all of 2022, right? And I think that's the regime that still a lot of the legacy macro investors are trying to figure out, is when, if ever, and I think that there will be a time when that correlation does kind of invert again. But if stocks and bonds don't give you that kind of inverse correlation, how does that investing landscape change in an inflationary regime? And so I think that's really not to say that Bitcoin's going to be inversely correlated to those things, but fixed income as an asset class has always been thought to be kind of a protection against equity market downturns. And in an inflationary regime, especially a sustained one, if that relationship no longer holds, then the value prop for bond investing is changed.
Yeah. Do you think that that's a sort of an awareness issue right now for those investors in fixed income, or is it more of a structural issue where they need more regulatory clarity to move capital to Bitcoin? Do they need more maturity in the Bitcoin infrastructure to get there? Is it a combination of all that? What do you think triggers that move?
Yeah, I mean, Bitcoin is like let's make no mistake, it's still it's extremely early, it's extremely nascent. I mean, just the occurrences and events of 2022, all the blow-ups, the fraud, like let's make no mistake about it, FTX was fraud, Three Arrows, all like, I mean, there's, the grayscale DCG situation, the whole 9 yards, BlockFi, etc., right? The SEC is clamping down all over for the kind of the white collar institutions, the legacy guys. They're happy to kind of just watch everything burn from the sidelines for a moment, and I don't think they're too eager to kind of YOLO everything, or like a retail investor might. Yeah. So it's just a different mindset. I do think that there will be some institutional interest once kind of the dust settles a bit, and I think that's where the opportunity lies, right? Because you or I don't have to go through the same level of compliance and regulatory hoopla that Bridgewater does, or a pension or an insurance firm, yeah. Right? But yeah, I think they will come. I think the risk-adjusted returns of Bitcoin will prove to be superior. But yeah, it's just very misunderstood. But like all the fundamentals of Bitcoin, right? Like this is what I talk to people all the time. It's like if you just look at any metric, right? You could look at hash rate. You could look at like wallet metrics. You could look at I mean, really, like there's unlimited amounts of data with Bitcoin. It's all at all-time highs except the exchange rate, right? And so like there's a kind of a misunderstanding that like, oh, this thing has finally crashed, right? It's crashed 80% for like the 5th time in its history, but now it's dead this time. And whenever you look at Bitcoin's chart, all-time chart in linear terms, it's either a massive bubble or it's a massive burst, and there's really never anything in between. And if you look at like a logarithmic chart, you can really get a clear story of like what's actually happening. It's that this thing's going through massive boom and busts on its way to becoming somewhat of a global reserve asset, or something maybe much bigger.
Yeah.
So I think one of the doubts that I always hear is, are you too late to Bitcoin? What would be your response to that, Dylan?
No, it's not too late. And I think even that question is almost like it incites a kind of emotional response. It's like either like a FOMO or like a, like it is almost like a get rich quick framing to that. With more so like, if the Bitcoin thesis is right, it's never too late, because Bitcoin is just a monetary asset that it's money, right?
Wait, you just mentioned the Bitcoin thesis. If you could summarize it in 2 minutes, what is the Bitcoin thesis, Dylan?
The Bitcoin thesis is that we now have a superior engineering solution to the problem, or to what money is, and that's a really big concept that goes back thousands of years of human history, but where gold kind of couldn't solve for portability across space, and fiat doesn't work for portability, for value transfer across time. Bitcoin solves for both the saleability or portability across time and space, because gold couldn't scale for modern economies. You needed paperback IOUs. That trust inherent in the system for gold was what led to fractional reserve banking, what led to the fiat currency era that we're in today. Politically, there's obviously a desire to create more money, right? If you can print money, you will. That's just basic human and economic incentives. And so Bitcoin, as an engineering implementation, as an engineering solution, open source software, solves those. So that's my thesis, and I don't think that's particularly unique to me. I think a lot of people believe that, but that's the investable framework, and I think that market, that total addressable market, is the biggest in the world, right? Like there's not a TAM, total addressable market, bigger than one for money. Yeah.
Beautiful. Ladies and gentlemen, please give a round of applause to Dylan LeClair and Ryan Flynn.
So the price of Bitcoin goes up.
No sell button. No sell button.
Bitcoin